We all know and hear from the media and investment professionals that markets can be volatile and that they don't always go up. Investors have definitely been living that axiom in 2022. At Smith & Howard Wealth Management, we believe it's important to have a balanced perspective on what's happening in the markets and why, for stocks and bonds. Unlike a number of sell-offs over the last decade, the first half of 2022 has seen both stocks and bonds upended. Several issues are weighing on financial markets, but perhaps none more important than high inflation and its impact on global interest rate policies. In these two short segments, I'll give our thoughts on two inflation-oriented questions that we've gotten recently. One, why would I want to own bonds if the Fed is still in the process of raising rates? And two, how much of the sell-off in stocks has been inflation-related? Part one on bonds coming up. Be sure to check out part two on stocks as well. Weakness and volatility in the stock market is never pleasant, but it's also not unexpected or out of the norm. Weakness and volatility in fixed income or bonds, however, isn't nearly so common or expected. Over the last 42 years on a calendar year basis, the core bond benchmark in the US has been negative just 4 times. And the average return of those 4 periods? Negative 1.8%. That means that most investors today have never seen meaningfully negative returns in fixed income. For those investors, the past 6 months have been eye-opening and have raised a number of questions. Most pointedly, if bond returns are negative because interest rates are rising, and the Fed is expected to continue to raise rates, why should I bother to own fixed income? It's a reasonable question, and the argument seems logical or even intuitive. Investing is rarely ever quite that simple, though. We can't say that bond returns will be positive next quarter or the remainder of the year, but we do think there are good reasons for investors to, 1, not abandon bonds altogether, and 2, be more optimistic about future returns. Probably the most important reason is that there is a good chance we've seen the worst in bonds. Although the Fed is likely to continue to raise rates, this is now largely already priced into markets. Markets are always anticipating and adjusting for what they think will happen. And that is in large part why bonds have already sold off so much. This becomes a bit clearer when we compare the difference in yields for various parts of the bond market since the end of 2021 with what the Fed has done year to date. Through April month end, the Fed had raised rates just once by 0.25%. Yet as we can see on the chart, most market yields have increased, represented by the black bar and number, by far more than that. For example, the yield on the US aggregate bond index, circled here, had already increased by 1.7%. Another reason would be the ability of bonds to again act as a stabilizer, ballast, or even contribute positively to performance going forward. When the 10-year US Treasury yield dropped below 1% during the pandemic, the upside from that point was extremely limited. Today, the 10-year yield is close to 3%. That's still low by historic standards, but the risk to reward is much better. This illustration from JP Morgan from May 4th, when the 10-year was just shy of 3%, does a nice job showing this. Over the next 12 months, if rates stabilize or move lower, as shown on the right-hand side of this chart, investors could actually enjoy meaningful upside in bonds. The obvious follow-up question to that is, why would anyone assume rates would move lower if the Fed is still in the process of raising them? Well, a natural byproduct of the Fed's fight against inflation is slower economic growth. The Fed hopes to engineer a soft landing, but they'll be walking a bit of a tightrope. Their plan will be to raise rates enough to curb inflation, but not so much that the economy stalls or drops into a recession. If those rate increases were to result in economic growth rates dropping too much, we could see the Fed reverse course and actually reduce rates, something we'd expect to have a positive effect on bond returns. I'll add that in that scenario, stocks likely don't fare as well, and investors may be very happy that they kept some portion of their portfolio in bonds. We are big believers that the best short-term strategy is to keep a long-term focus. And for long-term investors, we want to try and view what is going on in both stocks and bonds as an opportunity. Keep watching as we talk about inflation, interest rates, and stocks in part 2, and we'll tie it all together. Look for our contact information at the end of this segment in part 2 if you'd like to speak with us.